Every day, 1/5 of the world's oil squeezes through a passage barely 21 miles wide, the Strait of Hormuz. If it vanished tomorrow, not blocked, not contested, just gone, Brent crude would spike 40% before most people finished breakfast. China loses access to 7.5 million barrels a day. 6 exporting nations have no route to market. And that's just the first 24 hours. Roughly 20% of the world's oil supply, about 21 million barrels every single day, moves through the Strait of Hormuz. The flow is not just a headline number, it's the backbone of global energy, linking oil fields in the Persian Gulf to refineries and consumers on nearly every continent. Saudi Arabia, Iraq, the United Arab Emirates, Kuwait, and Iran together account for the bulk of these exports, with Saudi shipments alone making up about 4 million barrels per day. Tanker traffic, tracked by satellite and AIS signals, averages more than 2,500 loaded vessels a month, forming a steady procession through a channel barely wide enough for 2 ships to pass at once. Most of this oil is not headed west. Over 80% is bound for Asia, with China standing as the single largest importer. On a typical day, Chinese refineries process 7.5 million barrels that originated on the far side of Hormuz, nearly a third of their national consumption. India takes in around 3 million barrels, while Japan and South Korea combined absorb about 2.2 million. For these economies, Hormuz is not just a route, it is a lifeline. A sudden loss would strip Asian refiners of up to 8 million barrels a day, a blow that storage tanks and floating reserves could cushion for only a matter of weeks. The vulnerability is not evenly spread. For Japan and South Korea, more than half of all crude imports rely on this single strait. Even the United States, with its vast domestic production, draws about 1.1 million barrels a day through Hormuz to supply Gulf Coast refineries. Europe, while less reliant, still receives about 1.5 million barrels daily, enough to make any interruption felt across its supply chain. An International Energy Agency analyst summarized it this way: "No other choke point on Earth moves this much oil, this consistently, to so many critical economies." The numbers tell the story. 1/5 of global oil, 6 major exporters, and a handful of importers whose refineries are calibrated for Gulf crude. If Hormuz disappears, the world does not just lose a shipping lane, it loses the central artery of the modern energy system. Trading floors in London, New York, and Singapore erupt as the news breaks. The Strait of Hormuz is gone. Screens flash red and green. Algorithms scramble to reprice 1/5 of global oil supply out of existence. Within minutes, Brent crude leaps from $125 to $170 a barrel, a 36% surge that rips through every energy desk on the planet. On the Intercontinental Exchange, buy orders pile up so quickly that matching engines lag, and the bid-ask spread widens to levels not seen since the 2008 financial crisis. The options market reacts even faster. OVX, the CBOE Oil Volatility Index, jumps from a steady 25% to over 80% in less than an hour. Option premiums balloon. Traders who wrote out-of-the-money calls scramble to buy them back at a loss, while market makers hike margin requirements to keep up with the flood of volatility. A senior analyst at Wood Mackenzie puts it bluntly: "This is not just a supply shock, it is a liquidity event. Every model we use is out the window. Hedge funds and commodity pools rush to unwind short positions, triggering a feedback loop that drives prices even higher. Exchange circuit breakers halt Brent futures after a 7% move, only to reopen 10 minutes later with prices gapping up again. The ICE and the CME see record volumes on front-month contracts, with open interest collapsing as speculators flee. The Dubai Brent spread balloons past $60, signaling Asia's sudden scramble for replacement barrels. Currency markets are swept along. The dollar weakens against the Saudi rial and Norwegian krone, while oil-linked equities plummet. Energy giants see tens of billions erased from their market caps in a single afternoon. Meanwhile, Options volatility metrics tracked by every major bank flash warnings that this is now a tail risk event, with implied volatility above 80%. The market is pricing in daily swings of $15 to $20 per barrel, an unprecedented risk regime. The first 24 hours are chaos. No amount of strategic reserves or pipeline rerouting can alter the price action on a day when the world's main artery for oil has simply vanished. In the words of one trading desk chief, we are not just repricing oil, we are repricing risk itself. Loaded tankers bound for Asia, suddenly cut off from the Strait of Hormuz, swing south toward the Cape of Good Hope. The detour adds nearly 2 weeks, 12 to 15 days, to every voyage. For a standard very large crude carrier, that means burning through another $9 per barrel in freight, crew, and insurance. A shipping analyst at Clarkson's tracks the surge. Each day, another 3 million barrels are stuck at sea, waiting for the long way around. The world's floating storage, giant tankers anchored off Fujairah and Ras Tanura, becomes a temporary buffer, holding up to 15 million barrels. But at current drawdown rates, that's less than a day's lost flow. In India, the Panipat refinery faces a stark calculation, with its feedstock cut by 3 million barrels a day. Managers dip into on-site tanks, hoping the 20-day inventory will last until alternative shipments arrive. The refinery's crude slate is built for medium-sour Gulf blends. Switching to West African grades is not just a paperwork change. It means recalibrating the entire process, accepting lower yields, and absorbing higher costs. The refinery manager's update to headquarters is blunt. We can stretch to 3 weeks, maybe a little more, but then we start rationing runs. Meanwhile, in Japan, the Yokohama plant draws down its 25-day buffer at a rate that leaves little margin for error. Imports from Alaska and Russia trickle in to replace lost Gulf crude, but the mismatch in quality and timing means reduced throughput and higher product prices. Across Asia, the same pattern repeats. Floating storage empties out, onshore tanks drain, and refineries cut runs or idle units. Pipelines that bypass Hormuz, like the UAE's Abu Dhabi to Fujairah line, run at full tilt, but their capacity barely dents the 20 million barrel daily shortfall. For exporters, the pain is immediate and local. Saudi Arabia's Ras Tanura hub, now landlocked, shifts to domestic supply, slashing export earnings by billions each week. Tankers that would have loaded at Basra or Jebel Ali queue up for new orders, or drift empty, waiting for a route that no longer exists. As one shipping desk puts it, the world's oil is still in the ground, but the lines that move it have snapped. Every extra day at sea, every barrel in floating storage, is a cost someone will pay. Soon. Electricity bills land with a new sting. In Saudi Arabia, the average household tariff jumps by over 4% within weeks, traced directly to the spike in oil prices. Kuwait and Egypt follow, with official filings showing 3 to 5% increases for homes and industries. For millions, the cost of keeping the lights on rises overnight, not from local shortages, but from a shock that began thousands of kilometers away, where tankers now idle or take the long route around Africa. A macroeconomist from the International Monetary Fund points to the numbers. A $15 to $20 jump in Brent crude translates into a 0.6 to 0.9 percentage point surge in global inflation, with energy-heavy economies hit hardest. In South Asia, fuel subsidies balloon by billions, forcing governments to choose between budget cuts and public unrest. At the same time, the world's navies shift into high alert. 2 United States carrier strike groups, the Enterprise and the George H.W. Bush, arrive in the Gulf within 48 hours, joined by British and Australian warships. Retired Rear Admiral John McCluskey describes the choreography: continuous air cover, destroyers screening merchant convoys, minesweepers clearing lanes for the few tankers still able to move. The message is unmistakable. Freedom of navigation is now a matter of national security, not just commerce. Insurance premiums for shipping soar, and war risk surcharges triple, making every barrel that escapes the Gulf even more expensive. Meanwhile, policymakers reach for their last resort levers. The International Energy Agency announces a coordinated release of 400 million barrels from emergency reserves, the largest in its history. The United States Strategic Petroleum Reserve, holding 714 million barrels, begins daily drawdowns at rates not seen since the First Gulf War. But the math is sobering. Even with all reserves combined, the world can only cover a fraction of the missing flow for a few weeks. Gasoline and diesel prices at the pump climb in tandem, and airline surcharges appear on every ticket. The limits of mitigation are plain. No amount of stockpiled oil or military might can fully substitute for the vanished strait. The system strains at every seam as the world scrambles to buy time and stave off the worst-case scenario. The world's energy grid still depends on a single, fragile corridor. 20% of global oil flows through it every day. As tension and volatility rise, the lesson is clear. The next shock may not wait for a warning. Fragility at this scale is everyone's risk. Share your thoughts below.